Hello everyone, this is Andrew McNair from SWAN Capital with our April 2022 SWAN Report. In this month's video, we're going to discuss some recent headlines that influence the financial markets, but I want to provide you some perspective on what all these developments may mean for you over the next few months ahead. Now, as always, please stay tuned at the end of this video for some required disclosure statements. So here at SWAN Capital, our market outlook remains cautious, and for good reason. We're keeping a close eye on inflation as well as geopolitical conflicts. And as the beginning of this year unfolded, we were really taking an aggressive approach by buying while potentially other people were selling. But now we have paused our buying and we're looking for additional volatility opportunities to buy more. But with the first quarter of 2022 in the books, here's the report card so far. Jobs appear plentiful. While consumers seem to be losing confidence, inflation is still too high, and the Federal Reserve is raising rates as the economy is continuing to decelerate. Plus, we still have a Russia and Ukraine situation, which really could go in any directions. And markets have clawed back a fair bit of the losses we saw early in the year, and even managed to gain 3.2% for the month of March. Although we saw a loss overall of 5% for the S&P 500 for the quarter, we've experienced the first loss since the quarter of 2020, the first quarter of 2020. But the market still seems to be very sensitive to any news that comes out of Ukraine, positive or negative. And you can see that the markets rally anytime that there's just a spark of ongoing negotiations or when the Russians say that they're de-escalating. Yet nothing even close to positive has panned out. The longer this situation remains unresolved, the greater the chance that something unintended may provoke a wider escalation of this conflict. Now, markets have also formed an unholy alliance with the price of oil. As oil spikes, markets are dropping and volatility picks up. The Russia-Ukraine situation, of course, is a major contributor to this dynamic, but so are our own self-inflicted wounds here in the US, which may have made this dependence on foreign energy supplies a real problem. Now, let's turn our attention to the Federal Reserve. The release of the Fed's minutes from its March meeting rattled markets. As the minutes showed, the Fed appeared poised to raise rates higher and faster and unwind its balance sheet sooner. And that was a signal that efforts to tame inflation were serious and warranted. And as you may have guessed, markets immediately went crazy with this information, with concerns that the Fed would go too far or too fast. And projections were thrown out as to where the rates will be by year end. If the Fed would drive the economy into a recession, would they drive the ship ashore with raising rates too fast? Now, interestingly enough, this talk of recession is omnipresent now. When we started the year, a recession was even a remote possibility. The same commentators also told us to expect a rate increase after June and to expect maybe 2 or 3 rate increases in 2022. Only after the Fed stopped buying bonds as it tapered and removed quantitative easing. Well, those projections appear very wrong and overly optimistic, causing markets to expect a slow, gradual transition with a soft landing. And the Russia-Ukraine conflict threw a huge wrench into these plans, which didn't appear all possible outcomes. They didn't consider things like raging inflation, exorbitant gas prices, and cratering customer and consumer confidence. All of this did not go unnoticed, and the yield curve has actually inverted several times as a result. And as it's been joked about, the last 12 inversions have predicted the last 6 recessions. Not to be too flippantly about this, but not every yield curve inversion has pushed us into a recession. However, we have always had an inversion before a recession in modern times. So we have to keep a close eye on that. Finally, the last thing to look at is the 30-year mortgage rate, which has crested over 5% for the first time since 2011. Low mortgage rates have helped drive this red-hot real estate market, and housing prices, of course, have soared because of it. However, if the 30-year rate hits 5.75 or higher, that would be a threshold where affordability becomes out of reach for most homeowners, and the housing market could stall or decline. Also, the housing market drives not only construction jobs, but also other items such as appliances and furniture sales. A possible slowdown in the housing market needs to be seriously monitored. So are we out of the woods? Let's see. If you're looking at jobs, things might seem fine. The ADP employment report for March came in at 455,000 jobs. The BLS report showed an increase of 431,000 non-payroll employment for last month. However, we have some serious headwinds, and we're nowhere near not seeing a resolution on some of these big headwinds, such as inflation, as well as the Fed's actions. So that's going to be it for this month's SWAN Report, and I want to thank you for listening every month consistently. And if you have questions about your own financial plan or your portfolio, give us a call at 850-380-9558. That's 850-380-9558. See you next month.